Thanks to inflation, our savings won't be worth the same in 5, 10, or even 15 years' time. Because of this, it's really important to consider learning how to invest in the stock market to mitigate the risks of inflation, as well as to help you generate long-term wealth. But obviously, the thought of investing can be pretty daunting, especially if you've never invested before. Because of this, I'm joined with Gabriel Nussbaum, aka That Money Guy, to share all the tips and tricks you need to help you kickstart your investing journey. Now, before we start, I want to share the following disclaimer that all of the information shared in this podcast episode is for educational purposes only and does not constitute financial advice. Hi, Gabriel. How are you doing today?
I'm doing great. Thank you for having me.
I can't believe we're wearing the same colour in this studio today.
This was completely done on purpose. Let's just go with that, because otherwise it's not the
I
coolest.
texted you beforehand, wanted to find out what you're wearing.
Summer, right? Summer look.
Absolutely. I mean, it is raining outside.
Let's
but
not talk about that.
Well, this is your first time on the podcast. How does it feel?
It feels great. It looks amazing. I can see that the upgrades to the podcast are doing good. And so, yeah, excited to be here. Excited for the chat.
So am I. And obviously, I'm sure we both know investing is such a popular topic that I'm very excited to have you in the studio to chat with me on the podcast about it today. But before we delve into all things investing, please introduce yourself to everyone listening.
Sure. I will give you a very quick summary. So, like you said, Gabriel, I am That Money Guy. It's just the name that I came up with. Don't ask why. And I have been creating personal finance content, I feel like yourself, since 2020.
Wow.
Mainly short form, predominantly short form, pretty much only short form.
Yeah.
And I've, made hundreds of videos and people decided that they were interested in the topic. And so it grew and grew to the point where I've left my full-time job last year to pursue this full time. And yeah, that is pretty much me in a sentence. There's a lot more stuff going on in my life, but we don't have that long on the podcast.
Sadly not, but you are absolutely smashing it. Can we just tell the listeners how many followers you've got online, please?
Sure. It's a scary number. It's 1.5 million people across platforms, but I just like to focus on talking to one person at a time. This is great for me. This is my comfort place.
And how does it feel to say you've got like 1.5 million followers?
It's nuts. I don't think I'll ever get used to it. I mean, I even remember like my first 1,000, 2,000 and hitting those milestones and just being so excited. And like how it gets normalized after a while and you stop thinking about it. But when I sit in these situations on a podcast and think about that kind of number, it's scary, daunting, a big responsibility, but on the flip side, exciting and an absolute privilege.
No, absolutely. I mean, like I said, you're smashing it. You should be so proud. I mean, I'd kill for those numbers. So feel free to send them some over to me.
Go on. You had her.
But obviously, like you said, you've now got a platform of 1.5 million people, which is wild. But what actually inspired you to start sharing information online?
So it's a great question. So I've always loved educating. I think that was the kind of key for me. And when I started creating content online, it wasn't just finance. I was kind of doing everything that piques my interest.
Yes.
So like personal development, getting into my graduate scheme, even things like fitness, just anything that I could educate people on that I kind of put under the umbrella of learning outside the classroom. And as I kind of delved deeper into it and created more and more content, I realized that was just too many topics for any audience to consume, let alone for me to create. And I was like, well, which one of these topics was most suitable for my audience? And at the time, I was working in finance. Most of my videos were actually about finance. They had a financial kind of theme. So when it was kind of about graduate schemes, I always focused on the salary and understanding that. And I made loads of videos about money. Even with fitness, I would talk about the kind of costs versus expenditure when it comes to buying the gear. Is it worth it? And all that stuff. And it just made sense to me. And so I kind of settled into that niche, let's say. My audience responded incredibly well to it. And it was just kind of a match made in heaven, because I knew that I was so interested in the topic, constantly teaching myself about it, that it just made sense.
I love that. And now, like you said, you've now got 1.5 million followers. You're doing wild things. I mean, you're on podcasts, you've worked with amazing brands. What's probably been the most exciting thing you've done since you created your platform?
You know what? No one's ever asked me that. A pretty standout moment was I did a brand or a campaign deal, /campaign with Samsung, and they stuck my face on the billboards in Piccadilly Circus. So for about 30 seconds, the massive ones, like the Times Square of London, my entire face was covering the entire thing.
No, wait, when was this?
It was a week before I left my job, so last year.
Wow.
And for me, having that kind of moment, it wasn't a paid gig. It wasn't like the best paid. It wasn't, there wasn't a massive audience there. It was just doing something that I never thought I could do, and it had purely come up because of like the hard work and effort that I'd put in. And yeah, pretty unique moment. I'm sure there are plenty of others that I've missed out on.
I mean, that is pretty big though.
That comes, that's pretty big. I mean, yeah. And then it zoomed into my areas of my face and I was like, cut, guys, cut. No need for that.
I'm sure that was like a huge milestone that made you think, oh my gosh, I'm so glad I started this platform.
Yeah. I mean, the truth is, and you'll resonate with this, is you don't start this because of that.
Yeah.
You don't start this because you think you're going to make money or build a career out of it or anything like that. It's just a hobby. Like you like to do it. And I think, like, aside from me talking about like wanting to educate people, specifically wanting to educate people on personal finance, has always been that kind of core resonating reason. Like the lack of education, the financial taboo we have in our society, especially in the UK, those kind of resonate and go through like really strongly with everything that I do. But obviously, over the long run, I did kind of have this idea of maybe one day it could become a full-time career because I love it so much. You'd love to turn your hobby into your career, and I've been lucky enough to be able to do that.
Amazing. Yeah. So proud. It's amazing, and I'm so glad we've become friends off the back of it as well.
That's wicked.
And we have you on the podcast. Now, I like to try and make things as lighthearted as possible on the podcast, especially because we're talking about money. But one of my first questions is, what's been the best purchase you've ever made?
That's a great question. So it's gonna be a bit of a weird answer, but it was the first time that I kind of invested into my business.
Okay.
So it was a simple purchase of buying a MacBook. Now, people will be like, well, how can that be the best purchase? Surely it's a car or, a property. Well, I rent, so that can't be the best purchase. But the reason why I picked that was, A, it was really expensive. And obviously it was kind of at a time where I wasn't bringing in that much money. I was still working, part-time and all that kind of stuff. But investing into myself through that allowed me to, for an example, putting out a YouTube video would take me about an hour and a half to export when you're exporting like a 10-minute footage.
Yeah.
On this computer, it would take me 10 minutes.
Wow.
And I mean, if anyone's in the world of content, they'll know that you don't export things just once. No. You export things several times, again and again and again. And just little things like that, like the time that it gave back to me, and the little things of smoothness. Like I was working on a 5, 6, 7-year-old laptop. Not saying it was a bad laptop, but this was a game changer for me. So it's really a weird one to say that's my best ever purchase, because I'd love to mention things like, in certain investments or maybe my pension, but I want to give like a tangible physical asset.
I mean,
so investing into my own business, into something that, would give me rewards down the line, both financial and time wise.
Yeah, I resonate with that a lot, because one of my first ever business purchases as well was a MacBook, and I was always that student at uni that would kind of envy all the students with like MacBooks, and even like when I was at school, some people had the luxury of having that, and I always saw that as such a big investment because they're not cheap, are they? So when I finally was able to kind of buy myself a MacBook, I was like, oh my God, have I made it?
Literally, have I made it? It was amazing. And shout out to Apple. If you guys want to sponsor the podcast, I mean, we will.
Literally, I'll take it. But also, I know you're very good with money. You share lots of tips online, but I'm keen to know, what's one purchase you probably regret?
Oh, now that is a great question. Probably when I dived into the world, now that I will go for non-tangible assets here, when I dived into the world of crypto for the first time.
Interesting.
I like to experiment, so I like to educate myself through doing.
Yes.
And this one probably wasn't the best case example for me. I dived in head first. There was a craze during lockdown and COVID. And I thought, what? The best way for me to learn is to put some skin in the game. And I very quickly learned my investing, let's say, character or style wasn't suited towards the amount that I put into that investment. And I know we're going to dive into investment, so this is a great kind of point to start on. So it's kind of a funny one, because normally your worst investments are your best learnings. Like it's the kind of failures are learnings. And it taught me a huge lesson about the kind of investor I am, and kind of my, ability to handle volatility and all that kind of stuff. So let's go with a non-tangible, volatile purchase of investing into crypto. We won't say how much, but let's just say it wasn't ideal.
Was it quite a lot?
It was a sizable amount. compared to my rest of my investing portfolio, but I've very quickly readjusted it now to make I can sleep at night now.
And this is it, isn't it? You know, I mean, this is why we're doing the podcast today, to kind of educate all of you guys listening at home how to invest wisely, how to invest maybe for the long term. Yeah, because I think there's so many benefits to investing. So yeah, I guess that kind of leads me nicely into my next question. Why should people, at least people our age or people listening to the podcast, why should they consider investing in the stock market?
Investing is an incredible tool. And I think you mentioned it in the introduction to the podcast, but investing is this idea of trying to somehow generate yourself returns that try to outperform inflation.
Yeah.
In particular, and just generally to maximize the potential of your money. This idea of making your money work hard for you is a term that's often used amongst, like really wealthy people. They make their money work hard. Their money creates more money. And often people look to savings accounts or bonds maybe even, but more likely saving accounts when it comes to doing that. But in recent years, I mean, we've learned the harsh lesson, especially our generation, that saving rates aren't always going to outperform inflation. I mean, let's take like the kind of highs of the past 2 years, the best savings accounts were probably about 6%. The highest inflation rate was about 11% at one point. Now we're getting to the point where inflation is starting to go below the best saving accounts. So they are looking good. But remember, if you're only outperforming inflation by 1 or 2%, that's kind of your actual growth rate.
Yes.
Whereas when you start to look at the long-term return rates of something like the stock market, and when we say the stock market, we're probably talking about things like, if you've ever heard the terms S&P 500, which is kind of a combination or a basket of the 500 biggest companies in America, or global index funds, which kind of cover, companies from all over the world. These have historically returned something in the region of 10%, obviously not taking into account inflation as well. And obviously, again, look up specific markets for their specific average rates and specific time periods. And when you hear that number 10% compared to, remember, we're looking at incredible saving rates right now of 5%, but go back 3-4 years ago, the best ones were 1% or 2%. It's this idea of long-term growth for your money. Not gambling, we're not trading, we're not going in and out in a day. We're looking to put our money somewhere and let it sit there for really long periods of time. And by that, I mean minimum 5 years, ideally 10, 15, 20. The longer, the better. And we'll dive into that in a little bit. But that is what investing should mean to young people. And another keyword I want to bring in at this point, which is vital, is the idea of compound interest.
Yes.
And this is the idea of, your interest earning interest. So often when you look at long-term investments, you kind of see this upward sloping curve. So it starts quite shallow and it kind of gets steeper and steeper and steeper. And that is essentially what compound interest is. Let's say after 1 year, if you get a 10% return on £100, it's £110. But a 10% return the following year isn't £10 now, it's £11.
Yes.
Fast forward that 40, 50 years and put that into an investment calculator and you'll be shocked by how much that returns in the long run.
Yeah, and I like the fact that you brought up making your money work harder for you, because so many of us now have become great savers, and I'm all for saving. I love that. However, like you said, with the impacts of inflation now, 5, 10, 15 years, our savings aren't going to be worth as much as what they are now. Like, I mean, I went to Aldi today. I bought my pack of wraps I normally get, and the same cost of what used to be, it was like 90p for 8 wraps. The price is still the same, and it's now gone to 6 wraps. That just kind of shows you how
inflation.
Yeah, it's inflation, isn't it? That's how and guys, if you don't know what inflation is, it just means the cost of goods rising, and obviously £10 today won't cover what £10 is going to cover in 15 years, which breaks my soul. But this is why we talk about investing, right? So I think it's really important that you touched on compound interest, because again, that's another way that you can actually make money on the stock market, and again, is very overlooked. So yeah, guys, make sure you pay attention to what it actually means to have compound interest on your savings and investments, and also by looking at compound interest graphs like you mentioned. I think they're a really good way of kind of showing you what you could potentially earn in the stock market, because again, some people always often get overwhelmed with how to invest in the stock market and are worried about the losses. But if anyone listening today wants to kind of make their very first investment, how can they actually go about doing so?
So investing is actually really simple for the average person, let's call them. You quite literally just need to find a platform that does this. Now, most banks even do this. Your bank accounts often provide this, but the best ones are normally, investment focused platforms.
Yes.
We'll probably shout out a few later on, but you can just type into Google best investing platforms, UK, USA, wherever you're based. And it will very quickly bring you up a list. Now look at the pros and cons of each of them, whether it's the cost, whether it's, a whole range of things. And that's the best way to start. Signing up, super simple, like you sign up to any bank, national insurance number, etc. And then obviously you have to remember that putting your money into an investment account isn't the same as actually investing. The money needs to go in and then be invested into a company.
Yeah.
One thing to note is you're often going to be offered two types of accounts.
Okay.
You're going to be offered a stocks and shares ISA or a general investment account. We can dive into that if you want, but the long and short of it is that a stocks and shares ISA should always be your first port of call. This is kind of the idea of ISAs, which are individual saving accounts. Everyone in the UK gets a £20,000 allowance across all the different types of saving account of the types of ISAs that there are, stocks and shares ISAs being one of them.
Yeah.
If you haven't filled up your allowance, you probably know if you filled up your allowance. If you haven't filled up your allowance, because most people don't, £20,000 is a huge amount, then start with a stocks and shares ISA. Sorry, a lot of tongue twisters in here before going to general investment. And all this does is it's like a tax protection, a tax wrapper around your money, so that the interest that you do earn today might not be so much, but in the future might be a huge amount of interest, hopefully, if you keep doing this consistently. And when you eventually withdraw it, you don't want to be paying tax on that.
No.
And you do in this country. Right now, I think it's over £1,000 we have as an allowance. So once you're earning over £1,000 in interest in a tax year, you start to pay interest on that. Again, it might not seem like a lot to someone today, but in 40 years, 50 years, if you've been really doing this consistently, and let's say, you've got this goal of having £1 million saved up by the time you retire. Let's say you earn 10% interest that year on your £1 million. That's 100K. Do you want to give half of that to the tax man?
No.
Thank you. Straight in. Imagine if you went, yes.
Yeah, just here you go.
Yeah. Potholes, please.
Literally that. No, I'm so glad you mentioned stocks and shares ISAs, because again, people kind of, like you said, you wanted to learn how to invest in the stock market by doing, and you did that with crypto, right? And I'm sure lots of other people want to do that as well. So guys, if you are looking to make your very first investment, open up that stocks and shares ISA, because it's a tax-free wrapper. Again, we don't want to be sharing more of our money with the government than we need to. I'm not sure if anyone loves paying their taxes. It has to be done, but we don't want to be paying more than we need to. So yeah, I think it's really important that we kind of share that point. So thank you very much for touching on that. Now, obviously, a lot of people always say to me, "Oh, like, I really want to invest, but I'm scared I'm going to lose all my money." I get it. Investing can be really daunting. What could potentially go wrong if you were to invest in the stock market?
So when I talk about investing, and I feel like you're the same, we're talking about long-term investments.
Yeah.
So the stock market can be volatile. It isn't as volatile as something, let's say, like crypto, which is known to have swings of, 100% in a year. But that also means that you could be exposed to losses of negative 100% in a year. Well, probably not 100%, but you know what I mean.
Yeah.
You could lose half your money in a year. And this has happened historically in the stock market. I mean, you got the 2008 financial crash where the stock market almost cut itself in half.
Yeah.
You've got COVID where we lost about 30% off the stock market. And people look at those and go, I don't want that to happen to my money. I can't afford that to happen to my money. So, I mean, these are just things to be wary of. In the short term, you can have negative returns. The value of your money can go down. You'll often hear that as like a disclaimer when it comes to investing. Now, this is kind of the flip side. However, over long periods of time, the trend of the stock market is upwards.
Yeah.
And when I said before about the average return of the stock market over a 20, 30-year period being around 10%, it doesn't mean that, like we said, that it's 10% every single year guaranteed. What it means is 1 year might be down 10, 1 year might be up 20. And then you see the averaging out slowly of 10% over a long period of time. So it is important to know that things can swing in the short term, but over the long term, you start to mitigate that volatility and start to kind of mitigate your risk level. Another thing to kind of be wary of is this idea of, withdrawing your money kind of when you don't need it. So again, I'm talking about long term and short term. Remember, when your money is kind of lower than maybe you invested in the first place, that only becomes realized, which means that you're only actually losing money when you withdraw it.
Yes.
If you leave it in there and it rebounds, like the stock market has every single time it's crashed in the past, it has always rebounded, and it's becoming quicker and quicker that period. So I think during COVID, it took literally 3 or 4 months for the stock market to rebound to where it was before the crash. If you don't withdraw it during that crash, you haven't technically lost any money. So that's another thing to be aware of. And the last risk that I want people to be aware of is this idea of kind of hype or investing into things that sound cool. So like, I remember being tempted in the early days when someone on Twitter would say, I've got this great idea or this great stock that you guys have to invest in. Like, I've done all this. Blah, blah, blah. If it doesn't resonate with the kind of investor you are, if you haven't done the research yourself, and if you don't understand it, these aren't the kind of investments for you to start playing around with at that time. Of course, you can start to look to invest into individual companies and see if there's a percentage of your portfolio you want to do for that. But for the majority of people, what you're looking to do is invest in a huge amount of companies so that, for example, let's say you invested every pound you have into Apple and Apple decided to crash. Shout out Apple again. And Apple just crashed. Not the saying that it's likely at all, but you never know what's going to go in this world. You don't want to be completely exposed to that company. So that's why when I talk about index funds, it's about buying huge amount, baskets of stocks, so that eventually, I mean, you kind of spread out the risk. One company goes down, but it doesn't matter. You've got 1,000 others, so you don't even feel the effect of that on your portfolio.
And that's the beauty of passive investing, isn't it? So you've got your active investor, you've got your passive investor. I'm personally a passive investor. How do you invest?
A mix, but I would say 95% is passive.
Yeah. And would you mind just kind of delving in a little bit more into what you mean by index funds?
Absolutely. So an index fund is kind of, imagine a fund is just a basket of stocks. Now, a fund can be anything from different industries. So you can have a fund on energy versus a fund on tech, to different countries. So you've got a developing fund, which looks at developing countries, you know, think about like the Far East and all that kind of stuff, to funds based on just US market. And then you have big and small funds. So funds that focus on small size companies versus size. It's just a massive descriptor word. And all you got to do is find the one that suits your personality. For the majority of people, or the majority of people on the internet that talk about personal finance, we speak about global tracking index funds. So funds that quite literally just track the global performance of the best companies in the world. And all this is quite literally, you are putting money to track their performance. You make one investment, you make one purchase, and all of a sudden you have thousands of companies that you've invested into, which is crazy to say. You don't have to make the decision. Let's say we went to something as specific as an index fund that tracked the S&P 500, like we said before, the 500 biggest companies in the US. You are quite literally, with one purchase, buying the 500 biggest companies in the US, weighted against kind of their, you know, what they are. So for example, Apple makes up 6% of that because it's just absolutely astronomical in terms of its size. And then you got Microsoft, Tesla, you go all the way down. You'll probably have companies like Ralph Lauren and Berkshire Hathaway again at the top as well. So you can have a look at the list of the companies within that. But that's all an index fund is. It's just a big basket of stocks that you can buy in one click.
And this is it. I think a lot of people complicate investing, and like you mentioned earlier, investing is so easy. It's just choosing what investment you want to invest in, right? Now, we're not obviously going to advise you to have to invest in index funds, but it can be a great way of mitigating your risk. Index funds can diversify your portfolio, so investing in a range of companies. Like we mentioned, we've got your Apple, your Amazon, your et cetera, in the S&P 500. If you had any interest in maybe investing in the UK stock market, then you've got the FTSE 100, FTSE 250, FTSE 300. I'm not going to list all the index funds, but you could take a look out there if you are interested in doing so. Now, I guess another question a lot of people often kind of ask me is, when it comes to investing, they don't know how much they should be investing. Now, I know you can't give advice, but how much would you kind of recommend roughly people should aim to invest on a regular basis?
The truth is, if you've never started, and like, let's say you're young, you're in your 20s or maybe even younger than that, the idea is just to get some skin in the game, so you get used to this feeling of investing. So even if we're looking at, you know, £5-10 a month, something really minimal that you wouldn't go and miss if that disappeared overnight, that's a great way to do it, because then you start to get the feeling like checking the app every day because you want to look at what the money's going up, going down, and getting used to those feelings, because that's how everyone, I promise you, everyone that starts investing, I did this. I mean, I don't know if you did this, but at the beginning, I checked my phone at least 3 times a day.
Okay, it wasn't that bad.
And it kind of, as you get used to it, it kind of drops down. Now, I don't even know. Maybe when I go and make a manual investment, I'll have a quick look at how it's doing. But generally, I've got no idea today how, like, where my investment, if it's up or if it's down. I mean, I know it's up because I looked about a month ago, but it should still, like, I know the general state of the stock market. But that's kind of my first advice, is just to like start with something nominal. The next is, can you start to invest money that, the idea is money that you won't miss. So if you're thinking to yourself, like, you know what, £50 a month out of my account, if that money disappeared, again, that wouldn't be a financial burden on myself. Because remember, investing, that kind of money can go up, it can go down. So you need to be able to live without it. Then what you're starting to think about is long-term savings. So what I always split my savings into short-term and long-term. Short-term less than 5 years for me, long-term more than 5 years. I always kind of prioritize and calculate my short-term savings. So let's say you want to buy a car in 3 years' time.
Yes.
How much is the car? Divide it by, monthly payments over 3 years. That's how much you need to put away. And once you've kind of covered your short-term savings and covered your expenses, the idea is to invest as much as you can, as early as you can. Because what you don't realize is investing at the age of 20 compared to investing at the age of starting at the age of 30 makes an astronomical difference. I wish we could show some numbers right now. But again, if you go on an investing calculator and just play around and take a look at the effects, it's crazy. We can sometimes be talking about double the amount of money
100%.
at the end of when you actually pull out that money at retirement. So it's this idea of the second best time to start investing was yesterday. The best time to start was yesterday. The second best time was today.
Yes.
Butchered that, but it was absolutely fine. So yeah, it's about as much as you can, as early as you can, and understanding that money is not for you, at least for 5 years.
Yes.
And if you can turn that into 10, 15, 20, I'll keep saying it because the longer, the better. That's the kind of money that should be going towards it. People often say, okay, but what percentage? The more money you can save is always the better. People always talk about should I be saving 10% or 15%? Well, can you save 15% of your salary? It's always better to save 15% without completely destroying, your life, your enjoyment, your happiness at your current age.
Yeah, I always say I wish I started investing the minute I walked out the womb. Think how much money I would have had.
Huge. Genuinely, it's crazy. And we're young. People who've started investing at 40 look at us and be like, I wish I started investing in my 20s. People in their 20s look at people who are 18, for example, and be like, why didn't I start investing the moment I turned 18? And people who are 18, you can't really invest younger than that unless your parents do it for you. So I don't know what you're looking back at, but why don't my parents set me up a junior ISA when I was born?
This is it. And this is why we talk about all these topics today on the podcast and generally, because we're just not educated about this in school. And I'm not going to sit here and promise you that you're going to make £1,000 worth of returns. But if you do start as little as you can, like you mentioned, it can be literally as little as £5, £1 now. There's no excuse because lots of platforms allow you to start with £1. If you start to become more comfortable with how much you're investing, then maybe increase that amount accordingly, because you actually just never know how much money you can potentially make on the stock market. I think, again, it's often overlooked, isn't it?
Yeah, and I just say it's a muscle. Genuinely, just grow the muscle. Once you start investing £5 a month, which means nothing to you, you'll start to look at it in 3 months and be like, well, I can make that 10, I can make that 20, I can make that 30. And that's the best way to start, I would say. Skin in the game, open the account, physically open it, get used to buying and picking, your investments, your funds, your stocks, whatever it is that suits your investment portfolio and your personality. And then so on from there, it can only go up.
Now, I guess some people are probably listening today and are finally ready to make that first investment. Do you have any recommended tools or apps to help people kind of do that?
Yeah, so I tell people to look in kind of one of two directions.
Okay.
The first direction, if you're ready to make that kind of investment, but you really feel like you have no idea or knowledge, is to look at things like robo investment platforms. You can look them up, Best Robo Investment Platforms UK. It will give you your answer because we don't want to kind of shout any specific platform. But what these is they'll just give you a survey about kind of your risk tolerance, how much money you have, your investing experience, and they'll just recommend a kind of portfolio that they've built out of a range. So let's say they have 10 different portfolios, 10 being the riskiest one being the least risky. They'll just tell the one that suits who you are, and you don't have to do anything else. Now, the only flip side of that is they come with slightly higher fees. So that's just something to be aware of, but that could be a great place to start. Then kind of the next step is to just, again, go online. And when I say tools like how do you find the best investing platform, just try one out. Genuinely, I say picking an investing platform is way more important than picking the right investment platform.
Interesting.
Because ultimately, by just picking one and starting with it now, it's going to be fine. Likelihood, if you're picking one from a website that says these are the best 5 in the country. And in a year's time, or the rules are going to change soon anyway, but currently you can only have one investing ISA per tax year, but the rules are hopefully going to change soon. We can start to have several. But for now, just pick one. And in a year's time, if you really don't like it, you'll know why you don't like it and you'll know why to pick a new one. So that's really good. And kind of the third tool that I would say is just to continue your education within this world. So it's not as much a tool as it is just the internet. Keep watching videos or listening to podcasts like this, watching videos that maybe go into slightly more detail if that's what you're interested in. maybe start to read books about investing. I'm sure, again, there are plenty off the top of my head. I can't give you any, but type in the 5 best investing books to read. Like, it genuinely is that easy with the internet. And that's why I keep saying it, because people love recommendations. And I could tell you, invest in this platform. Well, I can't actually do that, like tell you what to invest in, but I can say, like, this is my favorite platform and this is my favorite index fund. But I like people to make their own decisions and to kind of get a feel for it, which is why I say do your own research. That's how I did it. And I managed to figure everything out. And like I said, I had to start from scratch. So I know that you can do it too.
Yeah, no, thank you. I think that's such a wise outlook to have. And I think when it comes to recommendations, guys, honestly, my favorite website is the Money Saving Expert website. It will give you the top best do-it-yourself platforms, or to give you the best robo-advising platforms. Again, if you aren't comfortable with how to make an investment yourself, then using the robo-investing platforms are great, because they'll literally go, Gabriel, how risky are you feeling on a level of 1 to 5?
How risky are you feeling today? Today, yeah.
So if you, for that day, for example, you might be feeling a risk level of 2 out of 5. They'll create that whole portfolio for you. That just makes investing so simple. And then all you have to do is literally invest the money that you can afford to invest. But obviously, it goes without saying there's always that element of risk when investing in the stock market. So what are a couple of things people need to consider before investing in the stock market?
So I like to always say, get your house in order before you start investing. So remember, investing isn't stage 1 of personal finance. Investing is stage 4, stage 5. Yeah. You need to get kind of everything in the right place. So there are a few steps like this. I hope that I remember them all correctly. But the first thing is an emergency fund. You do not want to be withdrawing money from your investment account to fix your boiler, to repair your tire, to do that thing that you didn't expect to happen. That money, you should have something like 3 to 6 months is general advice and practice, but at least 1 month worth of living expenses in an accessible, high interest savings account. Savings,
Amen.
Not investment. We do not, remember, we're not touching our investment accounts for at least 5 years. So if something happens tomorrow, I'm sorry, mate, you can't touch it. So just be aware that you need to build that first. The second thing is about paying off high interest debt. What is the point of trying to get 10% interest in the stock market, average returns, when you have a 20% interest rate on your credit card that you haven't paid off? Just do the math. You're getting 20% interest charged on your debt, but only making 10% on like your actual money. Pay off that high interest rate first. And when people say, well, what is high interest rates? For me, it's kind of, I put that number at kind of above or below 7%. Some people say 6, some people say 8, some people say 9. Depends on your risk tolerance. But I mean, what I do is I say, the average return of the stock market is 10. I want to give myself a bit of a buffer zone, so I put it down to 7. If the interest rate is below 7, I can invest and pay off that debt, minimum payments. And if it's the reverse, I pay off the debt first as aggressively as possible and, invest and can wait. So that's kind of step number 2. And I think step number 3 is, people often overlook this, get your short-term savings and your short-term financial goals in order. If you want to buy a house in 3 years, again, that's not investing money, right? That's not money that you want to pull out, because I keep saying this minimum 5-year period. It's not like a hard rule, because I genuinely think it should be far longer than that. But I like to give people like a really minimum threshold. If you know that you want to be buying a property and need to save up a deposit in the next 3 years, don't put that money into your investment account. Think about, again, if I need £10,000, well, let's say 30 because it helps me with maths, but I need £30,000 in the next 3 years. That's £10,000 per year. That's what, £800 a month that I need to be putting away. Get that focus first, get that into a high interest savings account again, and start saving towards that goal, and then start to look towards the rest. And I'm sure there are plenty of other things that you can kind of do, but at that point, you are probably ready to start thinking about investing.
Brilliant. I think you broke those 3 considerations down perfectly. And I think I want to come back to the topic of the high interest debt. I think, again, like you said, it's so important to sort that out first, because why run when you haven't even started walking yet? I think it's really, really important that you've covered, how much debt you kind of owe, especially when debt isn't even 7%. I've never seen debt cost someone 7% before. Minimum I've probably seen is 12%. That's maybe on car finance. Credit card interest is probably like 20 to 30%. So yeah, guys, please pay off your high interest debt first before you start considering investing. That's probably what I'd recommend.
Yeah, I guess the only thing you could probably consider is like a mortgage. People will be like, that's a low interest debt. So often people say, well, do I want to pay off my mortgage or invest? That's the kind of one where you can start to think about investing first, unless mortgage rates go crazy high again and go above a certain amount. And I suppose the only other one that people often ask me about is about student loans.
Interesting.
They're like, student loans interest rates are really high right now. I think currently it's around 7%.
Yes.
So it's on my threshold number. So why am I not paying it off aggressively? And then we'll go into the debate of, well, is a student loan, is the repayment a debt or is it a tax? My personal approach is it's a tax.
Yes.
Again, maybe look into this. If you're interested, type in the debt versus tax debate of a student loan and make your own decision based off of that, of what you're comfortable with. Some people just want to get rid of all of their debts before they start investing, and that's fine.
Yeah, no, I think that's a very good point. I mean, we're not going to delve into student loans, so that's a whole other topic for another day. But yeah, I think for some of you guys, you probably will end up getting that wiped off more so than, you know. But anyway.
We digress.
Yeah. But Gabriel, honestly, thank you so much for joining me on the podcast today. It has been amazing having you sat in front of me in the studio, chatting about how you guys can kickstart your investing journey. Hopefully, many of you guys have written some key tips and facts to kind of help you on that journey. And Gabriel, you share some amazing content online. If anyone wanted to check you out or follow you online, where can they go to do so?
If you just search Gabriel That Money Guy into any social media platform, you'll see my beautiful face talking to itself, making silly videos, trying to educate this country on personal finance. So do that rather than me spelling out my name for you. That is far too difficult a spelling.
Well, as always, I'll leave all of the links in the podcast description. And like I said, Gabriel, thank you so much for joining me on the podcast.
Thank you for having me.